Thank you for joining Market News with Rodney Lake. This is a regular show of the GW Investment Institute where we discuss timely market topics. I'm Rodney Lake. I serve as Vice Dean for undergraduate programs at George Washington University School of Business. Let's get started. Welcome back. This is episode 5 for Market News with Rodney Lake. I'm your host, Rodney Lake. Now, in episode 4, you might have noticed something different. A very fancy studio instead of my office where we do a little makeshift setup for recording for Market News. Now we have this wonderful studio courtesy of the Duquesne family. Thank you, Rick and Dawn, and the whole Duquesne family. The Duquesne family studio, very much appreciated and a massive upgrade. Thanks. All right. So what's episode 5 about? It is Nvidia in the AI age. I tipped the hand in the last episode where we talked about the impact on businesses. Well, today we're going to talk about the company that everybody's been talking about in the AI space, which is Nvidia. And don't worry if you thought you missed Nvidia as far as, I missed the whole AI revolution. That's not the case. There's going to be so many derivative impacts. But today we're going to talk specifically about Nvidia. And again, mind the disclaimer. This is not investment advice. This is the work that we do at the Investment Institute and our students. And Nvidia happens to be the largest holding, thanks to some of the great work that our students did back in 2019, as an example, in Nvidia. And saw some of these things coming. But I want to talk a little bit about the company. And again, we're going to kind of use the framework, or not kind of, we are going to use the framework, the business management, price valuation, and balance sheet. That is the hallmark of the Investment Institute investment framework that we've built and used over years, and we've been able to outperform the market with our students. And so it's critical. And by the way, why does that work? Well, one reason is that we took most of it from Warren Buffett, and then we added a couple components ourselves. And so thank you, Mr. Buffett. He seems to be making it work for himself, but it was in his annual shareholder letter. So we use that and have been using it now for almost 20 years. So if you haven't heard of Nvidia, you haven't been watching any news. And so maybe I can't help you there. But what's Nvidia? It's a publicly traded company. It makes graphic processing units, GPUs, or what they call now accelerators. And so it's revolutionizing major categories. And so the company has really come onto the scene, and many people in the gaming world probably knew about Nvidia years ago. So it's not a new company, but certainly it's grown very large. And in some days, depending on the day, is the largest publicly traded company in the world. The current market cap for Nvidia is $3 trillion. If $3 trillion sounds like a lot of money, it is. It's 3 with a T. And so that has happened very recently. The company's valuation is up considerably. The market cap is up considerably over, let's say, the last year, and certainly year to date. But that's really, when you think about the timing, when ChatGPT was first released, everyone's focus was really drawn to, okay, what are all these AI applications and who is driving that as far as the hardware and the software? Well, at the center of this on the hardware side is Nvidia. And almost every company that's doing work in this space is using as many Nvidia chips as they can get their hands on. And we'll talk a little bit about the numbers. And so a graphic processing unit is a little bit different than a central processing unit, a CPU versus a GPU, this parallel compute. That type of computing just happens to be very good for AI applications in this math matrix that you need to do to create these renderings and other things, and certainly for the Gen AI pieces. And so it's not a new company, but certainly it's an important company. And again, it has been the forefront of certainly every investment decision that people have been making. If they're in Nvidia, should they be trimming their position? Should they be increasing their position? Should they be reducing? If you're not holding Nvidia shares, should we be involved in this company? Because it does seem to be right now at the center of everything artificial intelligence, everything AI. Jensen Huang, who's the CEO and co-founder of the company, has been, on the news a lot in a lot of different places, and we have a lot of respect for his work and his work ethic and all the things that he's been doing at the company. So we're just going to now cruise through business management, price valuation, and balance sheet for Nvidia. So this is the overview from the Investment Institute's point of view for Nvidia, and today's episode, number 5, is on that. And it's called Nvidia in the AI age, but it's really an overview of the company. And since this has all been happening, where do we stand? So I'll first talk a little bit about, the company. As we said, it's GPUs and accelerators, and we'll talk about who their customers are. in a second here. They're doing lots of research. When you talk about, okay, where's management deploying capital? They have a lot of research and development projects and collaborations with research institutions and universities. And that's really driving, okay, what's the next thing for them? So as an analyst, you got to always be thinking about where are they going and what's their strategic vision for the future. And the reason they got here today is because they planted seeds long ago in this accelerating computing, and it's really paying dividends for them. So first, let's talk about the business. And so just diving a little bit into the business, I mentioned already that the market cap for the company is now approximately $3 trillion. And so again, that's a big number. And some days, depending on how the companies are trading, Microsoft, Apple, Nvidia, it could be the largest publicly traded company in the world. Now, I had mentioned in the prior episode, if you watch episode 4, about the expansion of gross margins for companies that are using AI. Now, Nvidia is the AI company, and it's a hardware company. And when you think about hardware companies, you don't necessarily think about high profit margins on the hardware side. You typically think about software companies as having high profit margins, because to develop the next piece of software, to sell the next piece of software, the marginal cost is zero. And so selling that next thing is all profit. Whereas if you sell hardware, obviously there's cost of goods sold that go into that, and maybe the profit margins are not quite as good as software. But in this case, they're a hardware and software company. And if you look at the gross margins as of now, we're July 24 here as an example, it is 75% gross margins. And if that sounds high, that's because that's very high. And the net margins are 53%. So those are fantastic numbers. And so when you're thinking about, okay, how do I rate this business 1 through 10 on the scale for the Investment Institute, 10 being a great company, you're pushing towards 10 on this. It's very difficult to get gross margins and net margins any higher than this in a sustainable way. And we'll talk a little bit about the moat around the business here in a second. But next, let's talk about some more recent things. And I talked about how it jumped on the scene with this ChatGPT being the catalyst for the focus on the company. So if you look at free cash flow, and I have talked about that before in prior episodes, if you talk about free cash flow and where they were just a few years ago versus where they are now, in their fiscal year for 2021, they did $4.7 billion in free cash flow. As of the last 12 months, they did almost $40 billion in free cash flow. So you're talking about an 8+X on free cash flow in just 3 years. That is a massive difference. And when they're getting all this attention, it's because it's not just hype. People are buying their products. Their gross margins, their net margins are super high, and they're generating a ton of free cash flow now, especially relative to where they were. And so when you talk about increasing free cash flow 8 times in 3 years, that is very significant and very unusual. So that doesn't happen all the time, but it is this sort of tectonic shift happening in the AI world, and something for us to think about. So obviously, Nvidia sits at the top of that. So what's been growing? Well, their data center business is growing, and we'll talk a little bit about their customers. And so for their customers, just a little bit of a breakdown. I'm going to use some of my notes here to make sure I have the numbers correct. Microsoft accounts for 19% of the sales. So do you think Microsoft is going out of business? Probably not. Microsoft has a bulletproof balance sheet. Do you think that Microsoft's going to continue to buy their products? Probably. What's the alternative? Right now, there doesn't seem to be a real second place. So AMD sits way far down, and Intel and other chip makers seem to be far behind Nvidia, specifically on the GPU side. And so companies like Microsoft are buying as many H100s as they can, as an example. That's one of the products from Nvidia. So they're buying essentially whatever they can get, right? Whatever they can get, they're buying. And so just to list some of the other companies, again, that's 19% of sales. So a company like Microsoft, probably not going out of business, using in a lot of their data centers. So their data business center is growing by leaps and bounds. The next one is Meta. Meta probably not going out of business, 10%. Alphabet, which is Google, almost 7%. Amazon, 6%. Dell Technologies, almost 6%. Tesla, 3%. Lenovo, 2%. So these are all big companies, and they have, for the most part, good balance sheets, or if not, rock solid balance sheets. And so these are your top customers. They're really buying as much capacity as they can. So right now, the moat that we've talked about before too, and what Warren Buffett talks about, the moat around the business in Nvidia is, I would say, even now widening. It was wide already, and right now it's widening. Why? Because no one seems to have the ability to make the same types of chips, and certainly at scale, as Nvidia is. And by the way, Nvidia is not sitting still. The next thing that's coming out is going to be better than the current versions. So when you have a company that has this lead and seems very focused on maintaining and growing that lead, well, it's very difficult for other companies to catch up. Now, as an investor, you have to look with the long term. It's very likely, as the profit margins remain high, that companies will start to figure this out because there's a lot of incentive to do so. And for customers like Microsoft and Meta and Alphabet, they're going to be looking for alternatives as Nvidia raises their prices and continues to raise their prices. They're going to say, hey, well, maybe I can design some of my own chips, which Microsoft and Amazon are doing, and maybe that's going to make a dent in the business at the margins. It certainly hasn't done it to date. However, with enough time, it may happen where, okay, these companies are actually starting to make a material impact. It's not happening right now. And I would say for the foreseeable future, it doesn't seem like it's going to happen in any meaningful way. Nvidia is going to continue to sell as many chips as they can, and their products are sought after. And so when we talk about BNPB, the business of Nvidia right now is very strong, and I would say that it's actually improving. So when you, on the scale of 1 to 10 for the Investment Institute score, you're approaching 10. It has to at least be a 9 at the moment with these gross margins and net margins and the demand for their products. And then you look at, okay, who are the customers for those products? Those customers are very solid, sound, likely not to run out of cash. And does Microsoft want to fall behind Alphabet? Does Apple want to fall behind any of these players? No, a lot of these players are going to continue to buy things from Nvidia as long as they can get them. And so when you look at, so that's the business, and we might come back to some of the elements of the business, but those were some of the basic stats. Let's move on to management. Jensen Huang is a co-founder of the company. So you have a founder-led company right now, and obviously he cares deeply about this company and has gotten it to this point. It seems that he is up for the job to continue to scale this company and continue to grow this company. He certainly has a lot of his own wealth generated from shares of Nvidia. And so you have to think, okay, what's management doing on the allocation of capital, which we've talked about before in prior episodes? What's Jensen Huang allocating capital to? Well, they're still allocating significant resources to R&D to try to stay ahead. And so that's super important for you as an analyst to think about, okay, the management team, they're actually allocating capital to things that are going to help them not just now, but in 3 years, in 5 years, in 10 years. And one public example that we can all sort of do some basic math on is that a few years ago, Nvidia tried to buy ARM Technologies. And so that's the framework that a lot of companies use, including Nvidia, for their chips. And so they license these designs from ARM. And we'll get into that in another episode maybe. But they tried to buy ARM outright, and the price tag was $40 billion. Well, that didn't go through. The FTC ultimately blocked that. It took like 2 years for that all to play out. But they ultimately, that deal was blocked and did not happen for a variety of reasons. And now SoftBank was the owner of that company, and they spun it out as a publicly traded company. So it's a standalone publicly traded company now. So Jensen Huang and company tried to acquire it for $40 billion. The market cap for that company currently is $160 billion. So you're talking about a 4x on the valuation. So if they had gotten that deal to go through, you're talking about 4 times on the valuation side. So when you're evaluating as an analyst, is Jensen Huang and this management team up to the task of allocating capital? Well, here's a very public example where you have the data in front of you to say, like, it seems like he is. That's a huge number. That is a massive difference in a very short period of time. You're talking about a few years ago that they started this process, and now this company is publicly traded and it's worth a 4x of what they were trying to buy it for. And everyone kind of scoffed at the $40 billion prices. Maybe that's high. Well, it seems really low now comparatively, versus 160 billion, so, a basic 4x, that we'll take that. Thank you, Jensen Huang. Obviously, it didn't go through, but again, it gives you an idea of, okay, the types of acquisitions that they were looking for. And when you look at the other things that they're tucking in, Mellanox is an example, those things seem to be working out Obviously, once the company absorbs them, it's very difficult to know how it's actually contributing unless they really break it out. In this case, we have a public example that they didn't acquire, but you get price discovery because it becomes a publicly traded company. And so that is an example, is a great public-facing example where you can see the numbers yourself, and it looks like Jensen Huang and Company know what they're doing on the capital allocation side, and I would say that's fantastic. When we go back to what can companies do with their capital, they can grow the company, whether that's through acquisitions or investments in new products. They can pay down debt, they can buy back shares, or they can pay a dividend. They do have a small dividend, 0.03%, so it's not significant for shareholders, but they are paying dividends. Again, on the management side here, to close out, to give that a rating, I would say we're at least a 9 for this as well. So now you look at price valuation. This is where people get concerned, but they've been concerned about the valuation. So the forward PE, we won't get into all the valuation metrics. We're just going to use this, is 45 times. And so that seems rich for a lot of people, and they think that's high. And historically, it is. It's certainly not, by the way, though. People get concerned that, oh, this reminds me of 1999. That's not a valuation metric of 1999 and Pets.com and all these other companies. And by the way, Nvidia has real revenue and real margins and real earnings. So it's a very different situation. So when you compare one to the other, just be careful how you're comparing it. 45 times is historically high versus, let's say, the average company in the S&P 500. But I would also argue, and you should too if you're an analyst, that Nvidia is a better company, so it probably should trade at a premium. Now, what's the right number? Okay, that's the art and the science of trying to determine what's the right valuation, and that gets into how transformative this company might be and what sales could be in the future and how they can ultimately drive revenue growth. So we won't spend a lot of time on the valuation, but I will say that it's looked expensive all along the way. So when you bought it in 2019, as an example, if you bought it then, a lot of people said the same thing, that, the valuation's too high. And we had these debates even in our classes here at GW. We'd have student analysts that say it's a fair valuation, and I think we should own shares, which we do. And we have other students who argued against that and said it's too rich, and the valuation, it's overpriced, and it'll never grow into that multiple. Obviously, it has to this point. Now, whether it continues to grow into that multiple is your job and our job as analysts to figure out. And again, this is a big holding at the investment institute, so it's something that we think about almost every day. It's certainly every day that the market's open. All right. On the balance sheet side, you want to have ideally a net cash position if you can. And certainly you want to have a solid balance sheet. In the case of Nvidia, you're talking about $31 billion in cash and cash equivalents and $11 billion in net debt. So you're talking effectively $20 billion in net cash. And so $20 billion in the bank definitely helps you sleep at night if you're the company. So you're not really worried about paying the bills. You're certainly not worried about creditors in this case. And that reduces the probability for bankruptcy to something very low. And so de minimis. And so that's not something, the biggest risk for any business is going out of business, in bankruptcy in the case for U.S. publicly traded companies. And so with $20 billion in the bank, we're sleeping well at night with the balance sheet with Nvidia. So I'll go back to the price valuation in a second, but to close out the balance sheet part, the rating there, you also have to give it basically a 10, right? And so a 9 or a 10, because again, 20 billion makes you sleep. Now, on the valuation side, you probably would rate that a little bit lower because you do have to really get comfortable with the valuation. It's certainly not cheap, right? But great companies never are cheap. And so at the investment institute, we're very focused on buying high-quality companies that we can hold for a long period of time. The example that we've held the longest is Apple. It's one of the first companies that we bought in the first fund, the Ramsey Fund, all the way back in 2005, and we still own shares today, and that has gone up over 100 times as an example. And so we're looking for high-quality companies that can compound capital over time. Is Nvidia going to do that if we buy it at that price? Well, we'll see. But you're talking maybe a 7.5 or 8 on the valuation. And on the balance sheet, I think you've got to give it a 10. So overall, we'll mix the scores around a little bit, but you're certainly talking about a company overall score of a 9 as a composite, as an example. And so very challenging to find a better company right now. The price, obviously, people get hung up on that. And people think that, okay, this is all now overblown and we're talking 1999 valuations and hype. But I would argue that Nvidia obviously has real revenue and is a real company. It's something that we have to understand better is what's the future going to look like for Nvidia? What applications, again, all these companies are going to be using if you watch episode 4, and then what are the demands for that? So Nvidia seems to be the top producer for the chips, and there doesn't seem to be a real second place at the moment. So the durable competitive advantage for them is big right now. They're well managed, so business grade, management fantastic. The valuation, again, we can talk and debate about, and our analysts will continue to do that. And again, it's something that we think about all the time at the Investment Institute. What's the right number for that? What's the right position size in the portfolio because of that, as an example? And then a rock solid balance sheet. So again, overall, we're thinking something like a 9 for Nvidia for a composite score, and it's a fantastic business, but it deserves a lot of attention right now if you do own it or if you're thinking about owning it, because it is sitting at the core of what's happening in the world of AI, and it's something that all of you as analysts should be thinking about because they're sort of in that pole position. They're at the front of the line right now, and understanding that business and understanding where they're going is going to be important, even if you don't own shares. Now, that market might get deteriorated over time, but it seems like there's a big runway, and it's worth spending time to try to understand their business, the outlook, and what's the impact on other businesses. So that's a wrap for episode 5. I hope you got some use out of this episode. And again, we're delighted to be in the Ducas family studio, which is brand new, and it looks really great. Really appreciate everybody's time. See you next time for episode 6 for Market News with Rodney Lake. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.